Can you transfer your buy-to-let portfolio into a limited company? The simple answer is yes, but it can be costly and complex and is not necessarily right for everyone.
In today's episode of the Property Tax Show, we'll explore incorporation in more detail, including the benefits, the costs involved, routes to incorporate, and the potential reliefs that you can claim to minimise tax.
Hello and welcome to the Property Tax Show. I'm James Poyser.
And I'm Nadeem, Head of Tax at Provestor, the Property Accountants.
So Nadeem, incorporation, what is it exactly and why are more landlords considering incorporating?
Great question, James. It's a hot topic conversation we've had since 2016. And it's literally a process of registering your business, either an existing business into a limited company or a newly formed business into a limited company. The reason it's a hot topic is since 2016, as we've already discussed, Section 24 has had a major impact on a lot of landlords in terms of the tax cost to them. And of course, limited companies have become much more tax favourable from a Section 24 point of view. So we're having many more conversations with regards to those existing landlords who want to either transfer their portfolio to a limited company or newly formed landlords who want to open a limited company for their future purchases.
Okay, great. So in which case, is it predominantly Section 24 that's driving this change and push towards incorporation? Is it easy? What's the lowdown on incorporation?
Yeah, so from a tax angle, I probably would say the Section 24 has been a big driver, and that's purely because those basic rate earners or even higher rate tax earners have now been pushed into higher rate tax earners or additional rate tax earners, and therefore Section 24 has really pinched a lot of pockets of landlords, and therefore limited companies have become much more tax efficient to run. In conjunction with that, commercially, lending has become much more easier for a limited company, so landlords have now become much more open to using limited companies as maybe they weren't before.
Right, okay. So then in terms of how easy it is it just a case of, you make the decision and that's it, your properties are inside a limited company and away you go? Is it that simple?
No, we wish. There are things to consider. There are things to consider not only for existing landlords who have properties, but also for new landlords who are getting into the property game. If we go back to people who have a structure of properties in their personal name already, and those are the ones who have really been impacted by Section 24, let's be honest, there are costs and implications to consider when moving into a limited company. Very high level, we're talking about the legal costs, so it's never cheap to move properties across. We've of course got the lending issues, so a lot of individual landlords would have a number of mortgages with a number of different lenders and potentially locked into fixed periods for their mortgages, and therefore moving them across to a different product won't be cheap, and certainly it would be very difficult to do that all in one go to move into a limited company. Right,
okay. And am I right in thinking that it's akin to kind of selling your property and buying it again through the business? Is that the most common route and barrier? Because I guess there's costs associated with that. You mentioned the legal, but I guess you've got to consider stamp and things like that as well.
Absolutely. So when we talk about incorporation limited company, we've got to remember that's a separate legal entity. So that's actually, although you own the limited company and it belongs to you, it's not actually yourself. You're actually transferring your property to your limited company, a separate legal entity. So from a legal perspective, you do have to transfer, sell, gift, call it what you like, transfer the property across. And as we all know, transferring that will trigger stamp duty, capital gains, and all the usual things that we need to consider as landlords when we're selling properties.
Right, so it's not a silver bullet for Section 24 then. So in which case, if all these costs are involved, you've got to sell the property, buy it again through this limited company that you formed, look at all your mortgage products, do the whole evaluation. When is it? Because people are still doing it. So when is it right for people to do it?
Yeah. So we've had many conversations with the clients, and we talk about the cost benefits and the savings potentially of doing that. So it could well be that there are short-term costs associated with incorporating, but actually from a long-term perspective, if you've got plans to keep the portfolio, grow the portfolio, actually it may well work in your favour to do so, and maybe pay a little bit up front of the capital gains and stamp duty associated with that. In addition to that, we do have, recently there's been a case, the Ramsey versus HMRC case, which stipulates a partnership business can incorporate from an existing case to a limited company without paying the stamp duty and capital gains tax we've discussed there. And those are the types of conversations we're having quite regularly with clients now to see whether they're eligible for that relief, which avoids those taxes.
Okay, so I'll come back to partnerships in a second. Because the other thing that I often hear you talking about, Nadeem, when you're having consultations with landlords, is the other method, the other approach, which is basically letting some of your properties go and deciding that you're not going to move them to a limited company, but is the right time to sell them and invest in a new property through a limited company, because I think that's quite a common thing that you advise on as well.
Yeah, absolutely. And this is where we really have a hybrid of both, James. So we've got clients who have a number of properties in their portfolio, in their personal name, and it's not so cheap to move them to a limited company, let's be honest, because you've got a huge number of properties with lots of lending issues, lots of commercial and legal issues there to consider, and maybe not necessarily the right time to move to a limited company. But they've still got plans to actually grow their portfolio in the future and actually continue buying 5, 10, 15 properties. In those instances, what we advise is that you open a limited company going forward and actually buy any future properties within that structure. And of course, that removes any capital gains tax, lending issues, and stamp duty or whatever. Yeah. Well, not the stamp duty, you've got that pay stamp duty, you can't ignore stamp duty. But actually, it has a bit of a hybrid because we've now got a bit of both. We've got properties in our personal name, we've got properties in a limited company. What clients tend to do then is actually just reassess their entire portfolio and say, well, actually, look, yeah, great, the limited company structure is really working. We're being much more tax efficient. We've got 3, 4, 5 properties in our personal name. We've obviously got a full-time job potentially. Our income goes up and down, and Section 24 is still a little bit of a burden on us. And at that point, clients are having a bit of a reassess on their portfolio entirely, and maybe looking at some of those weaker properties, and deciding maybe whether it's the best thing to actually keep that in their portfolio. So although this isn't tax advice, it's more commercial kind of sense to have a good look at your portfolio, good time to sit back and review where you're making money, where you're potentially not making money, and maybe sell some of the weaker properties to sort of reinvest in the limited company. So it's a good time for clients to sort of really take a step back and understand where they're going with their portfolio.
Yes, and it just sounds like that's the kind of best practice, the hygiene stuff that landlords should be doing every so often anyways, checking in on their portfolios and just seeing if they've inadvertently got some dogs that need looking at and seeing if there's a better way to invest that capital. Okay, so you mentioned partnerships briefly then, Nadeem, and we had a chat this morning and realised actually we can probably do a whole episode on partnerships. So we're not going to go into a real deep dive now on partnerships because we'll do that next time. But let's just have a bit of a look at partnerships, because you mentioned the Ramsey case. I'm sure many of the viewers will be familiar with that. So partnerships, tell us a little bit more about it. So who should be considering a partnership? Who's it right for? And what's the benefit of the partnership route? Yeah,
sure. Yeah, so partnerships in general are 2 or more people who are working together in business with a view to making profits. It's as simple as that. There are different types of partnerships which we'll discuss later on maybe, but the core of the partnership, what we're trying to achieve with our clients, is to understand if that's going to be a tax efficient route for them to take, whether that's incorporating, i.e. the long-term goal of maybe moving a portfolio to a limited company, or maybe even just managing a portfolio as a partnership as opposed to individually. So we discussed the Ramsey case, and it's probably a right time to maybe just touch on that, because it's a very tax efficient way for a lot of our clients to potentially move or incorporate their portfolio across. And if I may, James, just go very briefly on the Ramsey case, and that was a case which went through upper tribunal with HMRC. And actually a lady called Mrs. Ramsey was able to demonstrate that her property portfolio was a business in its own right. Okay. And the way she was able to demonstrate that was by showing the court that effectively that business was her main form of income, firstly. She did all the management of the lettings of the property, and also it wasn't a hobby, it was commercially her business, her main form of income. Yeah. And because she was able to demonstrate that, HMRC were happy to agree that it was being run as a business, and therefore Section 162 of capital gains tax for incorporation and Schedule 15 of stamp duty was eligible for her. Now these are 2 key things when it comes to transferring, in terms of what we discussed about how costly it can be to moving a portfolio across. So things like the stamp duty and the CGT were basically exempt for her. So we're talking about exemptions from stamp duty and a rollover of a capital gains tax. So capital gains tax never completely disappears, but at the point she was able to move her portfolio across, she had no capital gains tax or stamp duty to consider. Yes. So these are the conversations we're having with a lot of our clients, and a lot of people are eligible to claim. It's a conversation we need to have with clients individually to see whether they are available for that relief. It's not open to anyone and everyone, because we are following case law here. But it's certainly a key relief available to a lot of investors out there.
And it sounds like the crux of what you're saying is trying to differentiate between somebody who's got a property portfolio that's a business versus it being an arm's length investment. Is that the kind of the crux of the Ramsey case, is proving that it's a business, and you've said those hallmarks of managing the portfolio yourself. It's your main source of
Absolutely,
income.
yeah. So you would have heard the key terms like investment and trade over the years, and this is exactly that. So when you have one or two buy-to-let properties on the side in your portfolio, HMRC perceive that to be an investment of sort.
Okay.
Whereas if you have a number of properties and it's your main form of income or your sole form of income between one of the two partners, then HMRC see that as more of a business. They see that as more of a commercial, business that you're undertaking, not sort of a hobby on the side.
Yeah.
And that then falls within the legislation of the reliefs we're trying to apply.
Yeah. Okay. So I think that's a really good overview of incorporation. I think we've discussed I think three things there, which is whether it's right for you, and there's the straightforward selling a property and buying it again through a limited company, which has the costs associated with it. You need to do the business case on that. The partnership route, where if you can prove that you're in business on your own account and you can make that move and potentially make tax savings, or just stepping back and saying, actually, neither of those two options are right, and you might divest some of your properties and invest in new ones.
Absolutely.
Brilliant.
Yeah,
Okay. Anything else to add, Nadeem?
No, I think it's my catchphrase in terms of it being a case-by-case basis, but it absolutely is when it comes to incorporations and partnerships, because no two incorporations are the same. So I will certainly say it's worth having a conversation with someone who understands incorporations to see whether any reliefs are applicable for you.
Yeah.
And if not, how to then just better manage and structure your business, because it could well be that you think incorporation is the right thing for you, but actually from a tax point of view in the long term, based on your growth plans, there are other ways we can mitigate your tax as well. So certainly worth having a conversation.
Brilliant. Okay, great. I think that's it. So I hope that was a good and useful insight from Nadeem on incorporation. I hope we all learned something there. Thank you for watching. If you liked this episode of the Property Tax Show, please hit the like button below. Please do subscribe and hit the bell icon for our future episodes. As we've mentioned, we'll probably be talking about partnerships in more detail next, so stay tuned to the Provestor channel. If you've got any questions, add your comments below, and Nadeem and his team are always around to help. And Nadeem also mentioned getting some professional advice, and Nadeem and his team are available for such advice. So if you're thinking about incorporating and you want a steer from a qualified tax accountant, then get in touch with Provestor. Nadeem and his team are here to help you. So that's it from us. Hope you enjoyed everything, and we'll see you next time.